Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at TLN, or Talen Energy Corporation. TLN owns and operates power infrastructure principally in the U.S. Here's the barchart.com technical opinion rating for TLN. The bar chart rating is a 100% buy with the strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows the TLN is well above the moving average line, so the monthly trend in TLN is up. Now we're going to look at the daily chart. The stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since the chart started, so the daily trend in TLN is up. Next, we're going to look at our daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. TLN is below the upper Keltner channel line, so TLN is inside the buy zone. Since the trend is up, we want to buy a call. TLN has 7 option chains to choose from. We're going to use the November 15 option chain. Right now, the November 15 options have 46 days to expiration. Here's most of the TLN option chain for November 15. TLN closed at 182.22 on Friday. That means any calls on the list from 95 to 180 are in the money. Let's take a look at the profit potential for purchasing the 180 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 180 call is 730 to 760. We tried to enter at the midpoint, so we'll use 745 as the buy price. Our call option calculator shows the profit potential for this call based on TLN price changes at option expiration from flat to a 12.5% increase in price. We can see that if the TLN stock price is flat at 182.22 at option expiration, the 180 call will lose 92.5% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out your trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 150 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 150 strike call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the TLN stock price is up 1%, the 150 call will lose 8.2% of its value. We want that to be break even or better, so the 150 call does not meet our requirements. Let's see if the 125 call will work. The bid-ask spread for the 125 call is 56.80 to 61.40. We tried to enter near the midpoint, so we'll use 59 even as the buy price. The 125 call works if the TLN stock price is up 1%. The 180 call, 125 call will make a 0.1% or a $4 profit. That's better than break even, so the 125 call is the one we'll buy. The call option purchase calculator also shows that if the TLN stock price increases by 2.5%, the 125 call will make a 4.7% or $278 profit. If the TLN stock price increases by 5%, the 125 call will make a 12.4% or $733 profit. If the TLN stock price increases by 7.5%, the 125 call will make a 20.1% or $1,189 profit. The 10% and plus 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the TLN stock price does not make the expected move up and remains flat at expiration, the 125 call would only lose minus 3% or minus $178 compared to the minus 92.5% or minus $2,723 loss for the 180 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the TLN November 15 expiration 160 strike call and sell to open the TLN November 15 expiration 170 strike call on a spread at a debit of $680. Oops, I went too quick on that. We're going to base our enterprises on the midpoint between the bid and ask prices. That means we'll buy the 160 call for $29.45 and sell the 170 call for $22.65. $29.45 minus $22.65 equals $680. So the entry price or debit cost for the spread is $680. The call option spread analysis calculator picture shows that the spread will make a 47.1% or $320 profit if the TLN stock price declines by 5%, remains flat, or increases in price when the options expire. If TLN is down 7.5% at expiration, the trade will make 25.8% or $175. Creating the debit spread will allow us to collect a $2,265 cash credit to our brokerage account for the sale of the 170 call. As we said on the previous slide, this reduces the cost of entering the spread to $680. Here's a note regarding earnings reports. The next TLN earnings report is scheduled for November 12th. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the TLN November 15 expiration 120 strike call for $63.60. We also reviewed the spread. The spread said to buy to open the TLN November 15 expiration 160 strike call and sell to open the No 15 expiration 170 strike call on a spread at a debit of $680. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.